Dan Shoemaker is our OSU Extension Field Specialist in Dairy Production Economics, and Diane will be talking to us about this topic. So Diane, thank you.
Thanks. In 30 minutes, so it'll be focused and brief. So I think the first thing as I kind of was getting ready for this, is really ask the question why. Why are we here talking about this today? And there are three numbers that sum it up pretty well. $1,266, $36, and negative $300 to $500. The first number was the net return for Ohio dairy farms in Ohio summary in 2014. On average, every cow had an income of over $1,200. 2015, $36. $36, and that includes 3 organic herds. They aren't worrying about their milk price right now. And as I look at what's happened with milk price this year and looked at what the producer price differential is for November, I estimate we'll probably have an average net return per cow somewhere between a loss of $300 to $500. Now that's the average of all herds. And within that, there are some herds that are doing really well. In 2015, the high 20% of herds, when on average, we netted $1,266 per cow. There were some over $2,000. But there were also farms who lost money. Each and every year, we have a huge range. And in 2015, the range between the herd that lost the most per cow and the herd that made the most per cow was $4,000. So there are some people who aren't feeling a whole lot of hurt right now, although, darn, I'm down $1,000 from last year. But there are also families that are experiencing a great deal of financial stress. So I decided to approach this in terms of 3 questions. First, is there enough cash? Is paying bills fun? Paying bills was kind of fun in 2014. Now it's like, mama's paying the bills, stay out of the house. How much of my business do I own? How much do I own today compared to last year, compared to 5 years ago? We'll talk about that a little more. And bottom line, are we making money, and are we making enough money? So what I'd like to do is share a few items that we can pull together on any farm. Some farms do a lot of analysis, some farms do very little, but there should be a couple documents that you can pull together, no matter what your interest or level of work has been in the business part of dairy farming beyond paying bills. And that would be using both your balance sheets, you need some balance sheets, and you need an income statement. And the balance sheets, you may have some that you do yourselves, you may have some that a lender has helped you put together, and you may not have one, but what a balance sheet is going to do is it's a picture of your business on a day and time. So we are at December 16th, and the best time to do a balance sheet is January 1. So if you haven't been doing it habitually, now is the time to get started. And then as we look at how do we do in 2016, we need to know what our business looked like on January 1st of 2015. How much did I own and how much did I owe? And then we do the same thing on January 1st this year. So that bookmarks our year, and then we can start really looking at how did our business do. So the balance sheet is very simple. On the left-hand side, you'll have the assets, everything you own. And that'll be divided up into what's cash or near cash and the more permanent things, your cows, your calves, your machinery, all the way down to stuff you don't ever want to sell, your land and your buildings. And then on the other side is, what do I owe somebody else? Whether it's a lender, whether it's a family member, whether it's the bills I haven't paid yet for feed that I've already used, and I'll pay those my next time. So that balance sheet is that picture. It basically takes your farm and puts it down on paper. I can look at your balance sheet and have a pretty good idea what your farm business looks like. And then the income statement. What money did I bring in and what money did I spend? And a simple way of thinking that is, what's your Schedule F? When you do your income taxes, they do a Schedule F. That's a rudimentary income statement. But those are the three kind of pieces of information every farm needs to dig out if they don't already have those. So question number one, is there enough cash? How do we get at that besides seeing what the bookkeeper looks like after they're done paying bills or they ran out of money? One of the first numbers that your lender might ask about or look at is your current ratio. And that comes from your balance sheet. So you have your balance sheet, and at the top you have current assets. And those current assets are cash, savings. Big one for dairy farms is our feed inventories, especially January 1. We hope there's a lot of feed on hand. And it's not cash, but it's near cash, and you're using it to make milk. It could be expenses that you've prepaid for next year. It's the milk check you haven't received yet for the milk that you've already shipped, accounts receivable. If you have steers out there, market livestock, you're feeding a few pigs, those are current assets. Those are going to be out of there in 12 months. So it's things that are near cash. And then balancing that out on your balance sheet are your current liabilities. What money do I have to pay to someone else within the next 12 months? So it would be, it's about time to sit down and write out the checks for December. So it would be those checks you still need to write for things and services and goods that you've already taken in. It would be if there's a stack that you just haven't been able, there hasn't been enough money before you got to the end of the pile. It would be the money that you still owe someone maybe from a month or 2 or 3 months ago. Credit card debt that's related to the farm is a current liability. The other thing would be a line of credit. If there's a line of credit, that's a current liability. And probably the other biggie there is going to be any principal that you need to pay on term debt that you have in the next 12 months. So if I have a long-term loan and I know that I have to pay $12,000 in principal on that in the next year, that's a current liability. So we're taking the cash and near cash stuff the business has and everything we owe in the next 12 months and dividing them. And so if I have, in my example, I had $1.3 million of current assets, theoretically, and $750,000 of current liabilities, my current ratio is 1.73. And so the easy way to think about that is it's telling us that we have $1.73 of current assets for every dollar that we need to pay somebody in the next 12 months. So we know what it is. What does it mean? It means that we have that $1.72 or 73, but is it good or not? And so here's a little scale that we can use to start evaluating that. And we certainly aren't in the strong, and we're falling there in the caution range. And over time, some of you may have seen the 15 measures of dairy farm competitiveness. We actually like to see it a little higher than that. And as I see farms working through these years that we've had and thinking back to how the dairy industry has changed in the last 10 years, let alone the last 20, I think we have to have more money on hand. You know, it used to be you'd see a farm that had $5 of current assets for every dollar of current liabilities, or $7. You think, wow, you know, what else could you be doing with that money? Well, putting it in the bank really hasn't been a big money maker lately. But when you think about how fast farms have blown through cash, just taking care of the business of milking cows, it's not a bad thing to have more cash on hand. So current ratio is one way to look at, is there enough money? Working capital is another one. Takes the same two numbers, current assets, current liabilities, and just what's the difference between the two? And so we hope, and in our example, it's positive. And it's a big number. Over time, we can see what the working capital has been for the dairy farms in the Ohio Farm Business Summary. Went down, trended up. 14 was a good year, so we see our highest level working capital there. And not surprisingly, we see that drop from 2014 to 2015. Cash was used up in 2015 and working capital dropped. So we know we have some, but do we know we have enough? Is $550,000 enough? If you have 100 or 200 cows, it might be. But if you have 1,000 cows, it may well not be. So in our example, we have the same working capital and estimating for this sample farm that there were gross revenues of 2.2 million. And so that working capital is 0.25, or we talk about it as a percent. What percent is my working capital, the dollars I have available to pay bills, take advantages of opportunities that come along, make sure I make my debt payments, compared to the total amount of money that comes into my business in a year. So at 2.25 or 25%, that would still be in a caution rating. Strong, we'd like to see greater than 30%. It averaged 14.5% for Ohio dairy farms last year that are involved in the farm business analysis, but it ranged from a negative 17% up to a positive 70%. So a big range in businesses, and we really don't know what that is until we start pushing the numbers, but not a difficult one to calculate. If we look at the same farms, here's the working capital we already saw, and then laid on top of that is the average working capital to gross revenues, and here's our legend over here. So this is 20%. So relatively strong in terms of working capital to gross revenues, or fair back here, but it's still an issue for Ohio dairy farms that participated